So good morning, everyone. We're going to give it a few minutes, just 1 or 2 minutes to allow everyone to log in and come into the webinar. Thank you for being here this morning. We have a great topic, very timely, helping small businesses, startups, especially if it's your first couple of years into this, preparing for your tax filings that need to get done in the next couple months or 3-4 months. We have Chris Delaney with us from Burdette. Chris is an expert, and we're very excited to have him here this morning. So important to it can be pretty overwhelming, especially if it's your first time filing for your business. There's a few pitfalls. Chris is going to coach us through this. We'll have plenty of time for Q&A. So there is a Q&A box at the bottom of your screen. If you have questions, please feel free to drop them in the Q&A box, and I can filter the questions as they come in. And we have a question that just came up in chat. So yes, confirming that we are recording the entirety of the session, and you can definitely share the recording with anyone that you feel could benefit from the presentation. So we'll share the link through our newsletter, through our website. And if you can't find the link to the recording, shoot us an email at slowsbdc@gmail.com, and we'll send you a link to the recording. So I think we'll jump right in. Chris, thank you so much for being with us this morning. It's so good to have you. Thank you for making the time. Thank you, Burdette, for being such a great supporter of the Cal Poly CIE SBDC. We're going to go through a couple of slides real quick. So we're the SBDC, the Small Business Development Center. We're one of 1,000 locations in the US. We give no-cost consulting, one-on-one consulting. So if you're a business owner and you need assistance in any type of facet of your business, we have 35 plus consultants on board that can sit with you one-on-one. Everything is virtual right now, but we do all of our consulting sessions on Zoom, and we can help you navigate sales and marketing, financial projections, taxes, lots and lots of whatever you need help with, manufacturing, et cetera, et cetera. Contact us, feel free to connect with us, and we will try and help you. Next slide, please. We're sponsored by the SBA and the GoBiz office at the state level. We use that funding to pay our consultants, or all of our consultants are paid to work with all the businesses that we work with throughout the county. Next slide. We have a very quick message that we'll present from one of our key sponsors, Maynard Cooper. So we'll just watch this quick little video. Thank you. We don't have the sound on the video, but maybe I can overlay until we figure out the sound. So Jamal is a partner at Maynard Cooper, and he's a corporate attorney. We have actually, they're a sponsor of the Cal Poly CIE SBDC. We'll try it again.
Emerging growth companies and venture capital firms, including with respect to equity management, financings, employment, and intellectual property matters. We are extremely proud to be a Founder Circle sponsor amongst an extraordinary circle of other dedicated philanthropists who recognize the immense value that Cal Poly's Center for Innovation and Entrepreneurship bring to the SLO community. We hope that each of you enjoys this upcoming training and workshop and are able to incorporate the knowledge and know-how that will be presented shortly to further help grow, develop, and accelerate your businesses.
Oops. Okay, next slide. Now, Chris, we're ready for you, ready to jump in. I think you're going to share screen your slide?
Yes, that's correct.
Perfect.
Excellent. So let me do that. Okay, can you see that, Judy?
Thank you so much. Perfect.
Perfect. Well, good morning and Happy New Year to you all. Thank you for having me come and present today. I was having lunch with with Corey Carpin and Judy Mahan a few months ago, and we were talking about how to better help and connect with startups here at the Hot House. My firm, Burdette, has historically done office hours with the Hot House, and they suggested doing a refresher at the beginning of the year to talk about all things taxes, kind of a way to merge a lot of the individual conversations that we have with all of you throughout the year during office hours, and try and combine it into one presentation here. So my name is Chris Delaney. I'm a senior tax manager with Burdette CPA firm. We have offices here in SLO, Paso, and Santa Maria. We have around 80 employees, and we work with both businesses and individuals on tax returns, tax planning, et cetera. Our firm has been a supporter and collaborator with the Hot House for over 5 years now, and we've assisted and worked with numerous startup companies here with filing tax returns, claiming R&D credits, business consulting, et cetera. So for startup companies, you have a lot of things to manage. Most importantly, trying to get your big idea off the ground, funded, and into reality. And oftentimes, accounting and taxes are a much relegated afterthought, kind of a, well, we can worry about all that once we start actually making money, right? And that's an easy and very understandable mindset to have. So one of my goals today is to try and shift that mindset at least a little bit, to get you all thinking about a few things related to taxes, and realizing even a small amount of time and energy invested now can really reap dividends down the road. So let's jump in. One of the first questions you have to decide is the type of entity to set up. We found most startups here at the Hot House choose a corporate structure, specifically a C corporation. You receive liability protection, and as a seed company trying to grow, the structure is generally attractive to potential investors. Another feature is you can award stock options, restricted stock awards in lieu of cash compensation, especially in those early years when cash is very scarce. And also, let's not forget about the benefits of qualified small business stock, should your idea turn out to be a really, really good one. One downside to the C corporation model is a double layer of taxation. First, at the corporate level, the corporation pays income taxes on net income. And then a second time when dividends are paid out to shareholders, those shareholders then have to pay tax on those dividends. Compare this with an S corporation or perhaps an LLC. These are known as flow-through entities that generally have a single layer of tax just at the shareholder level, but can sometimes be not as attractive to potential investors who really don't want to receive a K-1 and pay income tax on activity each year. So these are all things to be considering and thinking about as you're getting your company up and running. And speaking of stock options, you must ask yourself this question: to 83B or not to 83B? And I actually thought I was quite clever as I was writing this down for the presentation, until I did a quick Google search and discovered this was not an original phrase at all. The 83B election is important to keep in mind, as it allows you to be taxed based on the fair market value of the company when the restricted stock awards are granted, rather than when they vest down the road. And possibly, hopefully, the fair market value has gone up down the road. So this can lead to significant tax savings by making this election. Future growth in the value of the stock would then be taxed at long-term capital gains rates, as long as the holding period is at least 1 year, which is another benefit of 83B, in that it starts that clock ticking earlier for the preferential 1-year capital gains timeline. The clock starts ticking from the date the stock is granted, rather than the date the stock vests, if you make this election. Now, keep in mind, however, that by making the 83B election, you are essentially accelerating payment of income taxes. This may make good sense if the fair market value of the company is nominal, or you think there's significant upside potential to the stock value. However, should the company fail or your shares do not fully vest, i.e. you leave the company or terminate employment, etc., you may not be able to recover that upfront tax payment. The actual election itself is honestly a bit archaic. You have 30 days from the grant date to make it. So it comes up very quick. And there's actually no formal form, just a written statement that outlines a few required details that you then sign and mail into an IRS office. And I definitely recommend doing this via certified mailing so you can prove you mailed it in within the 30-day window, especially with the current IRS backlog of processing mail. And
Quick
as
question
I'm,
for you.
yeah,
Sorry, Chris.
yes, you
Listen,
can interrupt me.
So, you know, when our startups incorporate, we deem that, you know, it's a given that their valuation is pretty low. So typically, you know, and corporate attorneys typically recommend just file the 83B, no questions asked, just do it. So for us, it's a given that we that's what we would do.
Yes.
As kind of as an automated part of the process, if you will. So there's no question of whether or not to do it. The answer is yes, just do it. Pay the $100 up front rather than pay, you know, thousands and thousands of dollars later on. But would you agree with that in general?
I would agree with that. I mean, yeah, it's I think there's you know, we're kind of talking about like restricted stock awards that are given right up front, but you know, I think there's a potential down the road for these kind of restrictions on stock to be given. And so that might be more where you might want to pause if now the company is starting to grow and you have some valuation and now you're kind of going, okay, let me weigh the pros and cons. But yes,
for founders,
you know, when it's nominal and there's really no value, if any, to the company, it typically we would recommend making the election.
Okay, thanks.
Yeah, thank you for clarifying that. As I mentioned earlier, qualified small business stock can be another significant benefit for C Corporation shareholders. This allows sale of an original issuance of stock, meaning that it was issued directly from the corporation rather than purchasing from another shareholder. That is held for at least 5 years, and the corporation does need to meet certain small business activity requirements. It can be 100% excluded from capital gain. This is a federal-only provision. California, unfortunately, does not conform. It's not often that you'll find complete gain exclusion in the tax code, but qualified small business stock is definitely one of those rare exceptions. I do want to also point out that the House-passed version of the Build Back Better tax bill would potentially reduce its exclusion percentage from 100% down to 50% if your income is over certain thresholds. But honestly, this bill is a long way from getting passed in the Senate. So we really don't know what the final impact to something like qualified small business stock will actually be, if any. So just keep this in mind. It can be a significant tax savings down the road should you exit the company and sell your shares and get some of that gain exclusion. And let's talk next about the research and development credit. This is a fairly generous credit that can allow up to a 20% credit for Fed, 15% for California of your research expenses over a base amount. Research expenses generally include wages and supplies. They should involve a process of experimentation, trial and error to come up with a new or improved process or product. Again, kind of under that research and development umbrella idea. Now you might be saying, okay, that sounds great, but why do I need a tax credit? My company is posting losses each year, so we don't actually pay any income taxes. That's a great question. But here's where the kicker comes in. You can make an election to take the credit against payroll taxes rather than corporate income tax. This means that if you're paying out compensation to employees, you can get cash back in your company pocket by making this election. Now, the election is actually made on the income tax return, but then you can claim the credit on your quarterly payroll tax form 941. You can make this election for the first 5 years you are in existence. Well, more specifically, that you have gross receipts that are less than $5 million per year. And you can claim up to $250,000 in payroll tax credits annually. We have helped numerous hothouse startups with calculating the R&D credit and taking advantage of this payroll tax credit. So we strongly recommend you talk to a tax advisor about this when you go to file your corporate tax return to review your activities to see whether you qualify.
Chris, a
There-
question that came
yes.
in. For the 83B and the research credit, is that only valid for a C Corp or is it valid for an LLC as well?
So the 83B is just for C Corps. The R&D credit is available to C corporations, S corporations, LLCs. So yeah, it's not the credit's not limited to C corporations. Great question. There is a new provision going to effect this year that R&D expenses must be amortized or deducted over 5 years instead of deducted all upfront in the year that they're incurred, starting in 2022. We are still looking at how this will work and interplay with the R&D credit, but at least wanted to make you aware of it. The Build Back Better legislation, again, has only passed in the House, but would potentially delay the effective date to 2026. But just wanted to make you aware of that. I mean, this is definitely more of a nuanced piece, but could be a significant change, especially for startups who have a lot of R&D expenses that they're incurring. So now, you've selected your entity structure, you've considered the 83B election. If you're a C Corp, you think you might qualify and want to try and claim the R&D credit. So what's next? So filing your tax return, your entity tax return. So tax returns are due in the spring each year with a possible 6-month extension. C corporations are due April 15th, and S corporations, LLCs, partnerships are due March 15th. If I didn't put this in the slide, but if you were a sole proprietorship and we're just filing a Schedule C, that is just part of your 1040 personal tax return, and that would be due April 15th. So even if your company is in a loss, you still need to file an annual tax return. And I get that question a lot. Technically, yes, you have no tax due, but by filing a tax return, you can claim losses that will roll forward to future years to offset that significant income that I know all of your 5-year bar graph projections are claiming will come to pass. Also, keeping good records and timely filing tax returns will put you in a much better position for a future acquisition or merger, as it will be able to show that your house is in good order. And you always want to be in compliance with IRS and Franchise Tax Board, which is the California equivalent of the IRS. So the corporate tax return reflects income and expense activity during the year, balance sheet assets, liabilities, shareholder equity, as well as ownership disclosures, possibly R&D credit calculations if applicable. Another important election to consider when you're filing your first tax return is what tax basis method to choose. The two general options are cash or accrual. Cash basis is definitely the simplest. You recognize income when you receive cash, you recognize expenses when you pay out cash. Accrual basis is a bit more nuanced, as you recognize income and expenses more closely aligned to when the services are performed or earned, or when goods are transferred, rather than when cash is paid. There are further limitations on which method you can choose depending on whether you have inventory, but suffice to say, you want to carefully consider which method to choose before you file your first corporate tax return, as it is a binding election. You can subsequently change your method if you want to change from cash to accrual down the road for some reason, but it does require a fair amount of work in special forms to be filed with the IRS. So definitely want that to be on your radar. Again, it's an election you make when you first file your entity tax return. So how do you know what your income and expenses are? We recommend you use some type of accounting software. Some good options would be QuickBooks Online or Xero. Double-sided accounting can be tricky. So, we generally recommend consider hiring a bookkeeper or maybe even an online remote bookkeeper like BenchCo. We've had success with them with some of my clients that can provide you with monthly financial reports and analysis. Everything's virtual. And this will make tax time go way smoother. Plus, gives you better real-time results throughout the year of how your company is doing. For companies that begin having more robust inventory on hand and the tracking of that inventory needs, we do generally see a shift away from QuickBooks Online and into other inventory specialized software packages. And a few other items to keep in mind. 1099s. If your company paid more than $600 to any individual person or entity for services rendered during the calendar year, you are required to issue a 1099 to report that income to the IRS. And the penalties for not doing this or filing late can be steep. A best practice we recommend is to have potential vendors complete a signed W-9 before you engage in any business with them. And that W-9 provides the necessary information in order to determine whether that vendor is subject to 1099 requirements or not. The due date to file 1099s is by January 31st. So we have a few weeks here for January 31st, 2022. You have to file 1099s to applicable vendors for the 2021 calendar year. So I'd encourage you to review your books. It's a great time to do this, and see if you have any of those filing requirements. Payroll. Usually startup founders are working for free or maybe bartering for some top ramen, but once initial funding is received, we typically see a pivot to some level of payroll compensation. There are a lot of third-party payroll vendors out there: Paylocity, ADP, Paychex, Gusto. We think they charge pretty reasonable fees, and they take care of processing payroll and preparing and filing quarterly and annual payroll reports, W-2s, etc. We found the world of payroll can get real complex real quick. So we generally recommend using a payroll services just to make sure all the T's are crossed and I's are dotted, and that you can focus not on how do we get payroll exactly right, but on getting your idea up and running. Sales tax. There has been a pretty seismic shift in the past few years of a state's authority to tax out-of-state sales. There was a U.S. Supreme Court ruling a few years ago in 2018 with Wayfair, a popular online site, and many states have begun adopting various sales tax measures as a result of this ruling. So for example, if an out-of-state company sells more than $500,000 of product into California, it will be subject to California sales tax. So think about Amazon. There was a time when you would go on Amazon, you purchase an item, and there'd be no sales tax included. Well, now Amazon does collect sales tax. And those out-of-state companies have to collect and remit sales tax to the appropriate California jurisdictions. So this can get real convoluted when you consider all of the different states. Sometimes cities charge sales tax. There are third-party vendors such as Avalara that can monitor sales to each state. And if you're starting to get close to their threshold, California's 500,000, other states might be 100,000. Every state can kind of pick what their thresholds are. But a service like Avalara can give you a green light, a yellow light, or a red light, basically saying, what's your sales tax exposure? And if you're getting close, where that threshold is, and if you do hit it, they would take care of any sales tax filing requirements. Like I mentioned before, each state has its own flavor on what they assess sales tax on too. Tangible products, intangible subscriptions. For example, the state of Washington assesses sales tax on intangible subscriptions. California doesn't. So the matrix of sales tax state by state is very complicated. So just want to put this on your radar. If you start having significant out-of-state sales, this will definitely be something you'll want to look into. Even if you don't have an employee in that state, you don't have an office in that state, it's just purely selling to that state that can now create nexus where you are going to be responsible for collecting and remitting sales tax to that state. Fixed assets and depreciation. For items you purchase non-inventory that cost less than $2,500, you can generally expense or write them off in the year purchased as they are considered de minimis. For larger purchases or repairs, you may be required to capitalize and claim a depreciation deduction over a number of years. Thankfully, even if you are required to capitalize some expenses, you may still be able to claim 100% bonus depreciation in the first year for federal purposes. So you really end up in a similar position as if you had just deducted the expense anyways. But California does not allow bonus depreciation. So this is another example where good record keeping using accounting software is going to help identify potential fixed assets so that they can be properly accounted for on your financials and your tax return. And I didn't put this on the slide, but I do want to also hit on, there are a myriad of COVID-related tax credits that have been coming out and now really that have been out for a while. One thing I just want to draw your attention to is as it relates to employee retention credits for recovery startup businesses. And recovery startup businesses are businesses that started after February 15th, 2020. They have to have average gross receipts of $1 million or less. And you can potentially qualify for this employee retention credit in the third and fourth quarter 2021. And what the credit is based on is up to 70% of an employee's wages, up to $10,000 of wages per quarter. So we've been helping a lot of clients with this over the last 2 years, and some pretty significant tax credits that are coming from this. But obviously you have to be having payroll and have employees. Even if you've already filed your quarterly tax returns for those quarters, if you think you qualify for this, again, seek out a tax advisor, reach out to us, and we can help you with preparing amended quarterly payroll tax returns. Now, if you started before February 15, 2020, you can still get the credit, the employee retention credit, but it's a bit more stringent on do you qualify. You have to have certain revenue decreases compared to 2019 quarters, or potentially maybe you have been partially or fully shut down by the government, due to COVID. Think, a restaurant where dining in was no longer allowed. That would be considered a partial shutdown. There's a lot. We can take a real deep dive. We could have a whole two or three classes just on employee retention credits and COVID credits, but just something to, again, keep on your radar. And with all of these items, we recommend talking to a CPA, a tax advisor, earlier rather than later, to make sure you're taking advantage of what you can. So this really just brings me to the end of my presentation. I know I've covered a lot of topics today. Hopefully, at least some of them you found a little helpful. I think the fact that you're even participating in this webinar is a good sign that you're trying to be proactive about your company's financials and tax obligations. So that's great. And now is the perfect time, early January, to evaluate your accounting practices, talk to a CPA, and make sure you're on a good path going forward. Feel free to sign up for our office hours that we do every other week. We'd love to talk to you more about what you have going on. And again, thank you for allowing me to come and speak to you all. And we definitely have time for questions if any have.
Thanks so much, Chris. That was great. I want to highlight the fact that I think when you're a startup, you have to be proactive in all these filings. These are separate filings that need to be done. Sales tax or filings, you can do them all online now, but you have to actually proactively go onto the California website. I think it's the California. Oh, what's the name of them?
It's CFTDA.
Yeah, that's what
it's 5 letters, and they make it too complicated now. Let me see.
CFDT, but it's
CDTFA.
CDTFA.
California Department of Tax and Fee Administration.
That's right. Thank you.
Yes.
And so these are things that you're not going to receive reminders, or you have to proactively get in there, set up an account, register your company. If you've got any type of revenue coming in, you will have to pay some type of tax on that revenue, on, well, sales, if you're making sales. The acronym again, someone's asking in chat, it's CDTFA. No, yes.
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 Just put that.
Thank you. Thanks, Chris.
CDTFA.
CDTFA. So set up an account for your company and just, make sure, and these need to actually be paid quarterly. And if you don't pay them quarterly, there are penalties that kick in. So for any of these filings that you're not doing, there are penalties. You'll have to pay additional, there'll be an additional cost involved. Let's see, we have quite a few questions in the chat, so I'm going to check on that. Oh, it's actually more comments. This is great. Someone's saying that they got a bookkeeper in 2021. And it was the best thing they've ever done.
Yes, well done.
That's great. And they are hard to find. I've had lots of requests from people for recommendations on local bookkeepers, and they are busy. They're swamped. And thank you, Chris, for making suggestions on online online bookkeepers. You mentioned Benchco. So I'll definitely, I've made a note of that so that I can share that with our startups. Anything you can do online is helpful too, just, helps streamline the processes for sure.
Right.
But yeah, I just wanted to really highlight the fact that sales tax is not, you're not going to receive any reminders. You have to proactively set up an account, make those payments quarterly. What else? We talked about the 1099s, the W-9s, et cetera. The same thing. You're not going to receive a reminder or any kind of nudge. You have to proactively set those things up. So I want to encourage everyone to do that. And if we've given the overview here, what needs to get done, if you need to get in the weeds on the details of, what website, where, how, when, again, Chris mentioned open office hours, great opportunity to talk to Chris and figure out the step-by-step process. We have a question here. So before registering with CDTFA, is there a minimum amount of revenue, was a question from Rebecca.
I don't believe there is. I think once you start selling something that is subject to sales tax, let's say a tangible product or whatnot in California, you need to register for essentially a sales tax license. And then based on how much revenue you're kind of forecasting or how much sales tax you're forecasting, you'll have, if it's really low, it can be an annual filing. But typically most of what we see with our client base is quarterly, like Judy mentioned. So I would say if you have now, sometimes some businesses aren't subject to sales tax, depending on what they're doing. But definitely if it's probably something tangible, more than likely you'll be subject to sales tax. So I would say you go ahead and, like Judy said, proactively register and
set up your account. Yeah.
Reporting that, right?
Yeah. And actually, you actually have to set up an account to be able to do sales, period, because you need a license to sell products to the general public. So either way, that would prompt you to set up that account, get the license, start doing sales, and then start paying that sales tax. Yeah. So open office hours is reserved to SBDC clients. I just want to highlight that. I know there's some non-clients on the call, which is great. So if you do want to sign up to be a client, it will give you access to open office hours. And again, all of our services are free. We pay all our consultants through funding so that there's no cost to the business owners. So any of you who are on the recording right now would like to talk to Chris through open office hours, please contact us first. There is a link in the chat to sign up as a client. And once you sign up, then we can give you access to all these resources. And again, entirely for free. So we're here to support you. I'm going to leave it open for any other questions. And if nothing comes through, we'll share a few more slides about upcoming events and other items that we have going on here at the SBDC over the next few weeks. But Chris, thank you so much. Great overview. I think it's just really good to just have a sense of what's required, how to properly set up to prep for filing, and once you need to file, all these different steps that we need to take to make those filings, and make sure that we have a clean sets of information that we can use to make the tax filing at the IRS level by March 15.
It comes quick.
Yeah, it comes really, really fast. Yeah.
Yeah. Thank you for having me on, Judy.
Thanks so much. Really appreciate it. So here are some upcoming events that we have. AngelCon. If you are a startup and you want to apply for some funding from our group of investors, you need to apply before January 21st at midnight. So please don't miss that deadline. You can email us if you want the link to sign up. It's a AngelCon 2022 startup is the bit.ly link, but we can send it to you. Just email us at slosbdc@gmail.com. And our next coffee and conversation is next month with Connor McCarthy. He is a partner with Trust Ventures. So we'll hear from a venture firm that make investments in startups. Really excited and looking forward to our next session, February 9th at 8:30. Let's see, we have a question in the chat. How many startups have joined AngelCon? We don't know yet. We won't know until February 21st at midnight. Most startups apply at the very last minute. We get a sort of a flood of applications on that last day. But we typically get anywhere between 20 to 40 startups, 45 startups that apply to be considered. And we whittle it down to our top 12. The investors select their top 12. We listen to the pitches of the top 12, and then we pick our top 6. So there's room for 12 startups to actually pitch live in front of our investors. We're excited to see what comes through. Okay, that's it for today. If you have any questions, don't hesitate to contact us. Again, slosbdc@gmail.com. And Chris, thanks again for being with us this morning. Really, really appreciate your time. Thank you.
Thank you.
Take care, everyone. Have a great day.